Gold is approaching a major liquidity zone, and smart money is actively preparing their next move. Right now, my macro bias is bearish, but my primary focus is a potential sell setup just above the 40-30 liquidity target, provided we see one strict condition first. If you're looking at the obvious breakout levels today, you're probably looking at the exact wrong area. Let me show you where institutions are actually targeting, because if you're not tracking their footprints right now, you're going to get caught in a massive trap.
So let's lay out the opportunity first. As I mentioned, my current bias on gold remains structurally bearish on the macro scale, but we are operating inside a really aggressive bullish retracement phase. The immediate liquidity targets you absolutely need mapped on your charts today are 40-30 for buy-side liquidity and 39.92 for sell-side liquidity. That is the playing field.
Now, let me show you where institutions are actually aiming. Just look at the daily macro structure. It's undeniably bearish, right? We have a clean, methodical series of lower highs and lower lows. But here's the problem. Retail traders see this massive drop and they immediately try to short the bottom. What they're completely ignoring is that price is currently operating in a deep discount array. It's a highly undervalued zone used specifically for rebalancing institutional portfolios. Smart money is intentionally engineering a retracement up into premium supply zones before initiating that next major leg down. The real target isn't down at the bottom just yet, it's resting overhead, right above those old highs.
So before we drop into the lower time frames and pinpoint our entries, here's exactly what today's institutional trade plan looks like. Again, the bias is bearish macro paired with a bullish retracement intraday. Our primary setup relies heavily on waiting for pending M15 confirmation. The key liquidity targets we're hunting are 40-30 BSL and 39.92 SSL. And ultimately, our higher time frame objective is drawn right up to that H4 bearish fair value gap at 40.48. Remember, as institutional analysts, we don't chase price. We literally just sit on our hands and wait patiently for the algorithm to deliver to these exact levels.
And this right here is exactly why institutions are likely to attack that higher liquidity before dropping. Notice the H4 time frame on the left. We had a really aggressive sweep of sell-side liquidity down near 39.60. Now that wasn't an accident. Historically, sweeps of that magnitude are engineered to accumulate enough orders for a major reversal. That purge is what triggered this sharp, violent institutional displacement higher. And if you look at the H1 dealing range on the right, it confirms this logic perfectly. We got a confirmed bullish market structure shift directly following that sweep. Institutional buyers are stepping in, defending those higher lows, and driving price steadily upward to rebalance those unvisited premium arrays before any larger time frame distribution can actually happen.
Now, obviously, a structural shift like this doesn't happen in a vacuum. We've got severe volatility catalysts at play today. We're digesting escalating US and Iran geopolitical tensions alongside the Canadian CPI data release. Retail traders usually look at this kind of news as chaotic, scary, or unpredictable. Smart money? They just view it as a tool. These events are massive macro catalysts used strictly for liquidity engineering. They provide the exact volume and volatility needed to rapidly push price into our defined targets. The algorithm uses that sudden injection of volume to either sweep highs and trap early buyers or plunge price downward to clear out weak stops. It's an entirely mechanical process.
Which brings us to the two highly valid institutional order flow scenarios developing for us today. And both of these demand strict patience. Don't try to guess which path it will take. Wait for the chart to tip its hand. On the left, we've got our bullish retracement model. Price sweeps the 40-30 buy-side liquidity, pulls back cleanly into a discount array, and then expands aggressively toward our 40-48 target. On the right, we have the bearish continuation model. Price sweeps that exact same 40-30 BSL, but instead of pulling back, it instantly displaces down, signaling an aggressive institutional distribution straight toward the 39.92 sell-side liquidity.
Let's actually map out the executable buy scenario first. If you're tracking this setup, your entry zone sits strictly between 40.12 and 40.18. That's our M15 bullish fair value gap. Your stop loss has to go below structural invalidation at 39.98. Your first take profit is the immediate 40.32 liquidity pool, and the final target is that H4 gap at 40.48. But here is the absolutely critical rule. You do not just buy blindly. You have to wait for a controlled M15 pullback into this fair value gap, followed by a clear, undeniable bullish displacement. If you enter before that confirmation, you're literally just becoming the liquidity. However, smart money might be targeting something completely different if premium resistance holds up. So here is the alternate sell scenario. If price violently sweeps those equal highs and then immediately reverses, we're going to look for an entry on the retest of the H1 or M15 bearish order block.
roughly in that 40.30 to 40.35 area. Your stop loss sits securely above the newly swept high. Targets here would be the internal sell-side liquidity, followed by those external lows around the 4,000 to 40.20 zone. The trigger you absolutely need to see for this is a brutal change of character, a ChoCH, on the 15-minute chart right after the buy-side liquidity is taken. That signals an immediate shift in momentum and institutional distribution. But this upcoming liquidity pool changes everything. So where are retail traders actually going to get trapped today? Well, most of them are completely ignoring the fact that price is expanding heavily right now without a fresh retracement into a discount array. The market is flashing a massive warning signal, but sadly, most retail traders are just too busy smashing the buy button to notice the trap being set right in front of their eyes.
This is exactly where smart money is likely to spring that trap. Look closely at this M15 chart. We have a glaring buy-side liquidity pool resting right at 40.30. Impatient retail traders are going to see price surging toward this level, FOMO will kick in, and they'll blindly buy the breakout. But buying the top of an expansion candle that's heading straight into historical resistance, that is a low probability amateur mistake. Institutions are just waiting to use that retail buy pressure to pair their massive sell orders. That's either going to engineer a brief pullback into our 40.12 buy zone, or it'll spark a completely devastating reversal. Listen, if you buy the 40.30 breakout, you are the exit liquidity.
So, the immediate action for today is simple. We wait. Smart money confirmation just hasn't appeared on the charts yet. We are maintaining our macro bearish bias with intraday bullish retracement potential. Keep your eyes locked on that 40.30 liquidity sweep and watch exactly how price reacts. Now, if you enjoy this kind of institutional-grade explainer using ICT and smart money concepts, make sure to subscribe to ICT Market Theory. And if you want to trade alongside these exact setups, you can find the FXTM broker account link in the pinned comment below. Stay disciplined, wait for your model, and protect your capital. Because as gold approaches this critical threshold, the only question left is, when the trap snaps shut, whose liquidity will they be taking?